Hi, I'm John Pasalis, housing analyst and founding broker at Realosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview. Right now, I have the pleasure of speaking with Mikael Khan from the Bank of Canada. I first connected with Mikael back in 2017 when I shared some of my research on speculative home buying in the Greater Toronto Area's housing market in 2016. That was really leading up to sort of the bubble that we saw in those years. And I've kept in touch since then, again, sharing data and getting his valuable feedback on some of my research. But today we're going to be talking about his research and a note that he recently published, which I think really takes an interesting look at how to think about sort of the economic effects that COVID-19 might have on our economy. So without any further delay, let's jump right into my chat with Mikael Khan from the Bank of Canada. So, Mikael, thank you so much for joining us today. It's, of course, a great treat to have yourself, have someone working at the Bank of Canada share their insights, obviously, on what's going on economically in Canada following COVID, and, of course, to hear some of your thoughts on some of your most recent research in analyzing sort of the economic impact of this recession and sort of some different ways of looking at it. So thank you so much for joining us today.
Happy to be here.
Yeah, so I think what we'll do first, just to jump in, is to, before looking at kind of what the Bank of Canada's done, maybe if you can kind of give us a bit of a backgrounder on, kind of the Bank of Canada's role in our economy, sort of what their goals are with monetary policies, and maybe we'll start from the point of, their goals and their plans and some of the things they do in normal times, and then maybe we can look at sort of the things they've done in these sort of extreme periods that we're in now.
Right. So, okay, no, that sounds good. I can definitely walk you through. So I guess, I mean, so to start with, the the basic objective of monetary policy is to keep to preserve the value of money, and so that essentially entails keeping inflation low and relatively stable. So more specifically, the bank aims to keep inflation, near the midpoint of a target range of between 1% to 3%. That inflation targeting agreement is drawn up between the bank and the federal government. It's revisited every 5 years. And so how the bank actually goes about achieving its inflation target, at least in normal times, is to adjust its, the target for the overnight rate, which is also sometimes referred to the key policy interest rate. And what that is it's just the the rate at which financial institutions lend and borrow among themselves, kind of like at a very short horizon. And the basic idea there is that changes in that rate then affect various other interest rates in the economy, such as those on mortgages, other consumer loans, and so on. And so, just as a very simple example, if typically if inflation is running below target, the bank will lower its policy interest rate. That'll then transmit to other interest rates in the economy, spur borrowing and spending, put upward pressure on prices, and eventually help kind of restore inflation back to target. And so I guess that's sort of your very kind of conventional textbook monetary policy. Now, if you go back. Yeah, so
when you say when inflation is lagging, you're saying the Bank of Canada will basically lower their rates to encourage spending, to kind of push prices up in some ways a little bit closer to their targets. So I'm guessing the opposite, of course, is also true. If prices are rising too rapidly,
Exactly.
then they will increase interest rates in some ways to try to put the brakes on the economy. Does
Yeah,
that kind of make
absolutely.
sense?
No, exactly. That's exactly it. And so, I guess if you go back to March, when the seriousness of the pandemic and the related economic fallout were becoming evident, the bank at the time very quickly lowered its policy interest rate, and not just the Bank of Canada, but central banks across the world. And so here in Canada, we lowered the policy rate to 25 basis points, which is generally believed to be the effective lower bound. So that's about as low as rates can go. And like it's interesting because back then, with the economy shut down, you really wouldn't expect lower rates to have the sort of impacts we just discussed. But the idea at the time was really to help basically maintain confidence and make sure the economy was sort of on a solid footing, to recover once the economy does reopen, and that credit is there for people that need it. But then I think what's also interesting is that, like, the bank took a number of other actions at the time that sort of deviate from this very standard monetary policy, and I guess people might be a bit less familiar with those types of actions. So I won't go through each of them in detail, but I think a lot of them you can sort of pull under the umbrella of asset purchases. So essentially, the bank has been buying a wide range of financial assets, everything from Canada mortgage bonds to corporate and government bonds. And this was already done, at least initially, to ensure sort of smooth functioning of the financial system. So financial markets, especially back in March, were under a lot of stress. Not only was there a lot of volatility, just given all of the uncertainty surrounding the pandemic and its economic impact, but widespread demands for cash, liquidity was drying up, and that's really why the bank intervened to sort of restore sort of smooth functioning of financial markets. And so that's obviously quite a different policy to sort of usual interest rate policy. But I think the objectives at the end of the day are really the same, since without a smooth functioning financial system, you can't really have the sort of sustained recovery that we'll need to eventually get inflation back up.
So to unpack that a little bit, kind of many of these policies fall under this umbrella of probably something a lot of people have heard of called quantitative easing. Is that fair?
Sure. Yeah. Yeah, I mean, I know there was a bit of debate in the earlier stages about what to call it, and I think Governor Polas was just making the point that when it comes to the bank's purchases of government bonds, that at the time, just given that the objective was really sort of more on market functioning versus kind of traditional stimulus, that maybe it should be looked at a bit differently to sort of pure quantitative easing. But I think for sure now that markets are operating much more smoothly, and the banks continuing to make those purchases, they are now kind of playing sort of the more traditional stimulus type role that you would associate with quantitative easing, and I think the governor alluded to that as well in one of his recent speeches.
Yeah. So some of the side effects of those types of policy tools are, as you said, to bring some liquidity and some money back into the economy by basically buying these bonds from institutions holding them, right? And like, is another side effect that it, if a lot of bonds are being purchased, it also lowers the cost of funds for these longer term bonds?
Yeah, no, exactly. So I mean, like the basic idea is, when the central bank makes these purchases, like the prices of those assets go up, and that in turn lowers their yields. And so if you think about, for example, the bank's purchases of Government of Canada bonds, in the current environment, to the extent that those purchases lower the yield on, say, 5-year Government of Canada bonds, those then directly translate into declines in fixed mortgage rates that most consumers face.
Okay, so that's actually a very good example. So what you're saying is, because partly because the Bank of Canada is buying these Government of Canada bonds, it's lowering the interest on those, long-term Government of Canada bonds, which in return we're seeing in low 5-year mortgage rates, which are now, in the 2% range. So
Exactly.
that's pretty much a side effect of those types of policies.
Right.
That's awesome. That was super helpful. Thank you so much. I think that gives us a bit of a backgrounder on, monetary policies. Now, I think it would be great to kind of jump into a note that you co-authored at the bank. It's titled Household Indebtedness Risks in the Wake of COVID-19. It's on the Bank of Canada website. And I think it's a great note because one thing that I found interesting is that a lot of the talk we hear about right now, of course, is that a lot of people sort of looking at this slowdown through the lens of like a traditional recession. And one of the things that you kind of highlighted in your note was that may not be the best way to analyze what's going on today. And you took a slightly different approach. Maybe kind of walk us through the rationale for that type of thinking.
Sure. So I think just generally what's quite challenging about, the current situation is that, there really isn't any historical precedent to draw on. Of course, we've had other pandemics, but those were a very, very long time ago. The world was fundamentally a very different place back then. And, when we're faced with this type of situation, it is tempting to kind of go back and look at previous recessions. But, what we're going through right now is also fundamentally very different to a typical recession. And so, I think, looking at the pandemic, or at least its economic impacts as, through the lens of a large-scale natural disaster, that's probably sort of a better framework for thinking through, I think, at least the initial impacts. I think what those two things have in common is you have the sudden stop in economic activity for, very non-economic reasons, and, in this case being the public health crisis. And you'll often see pictures of things like take employment insurance claims, for example, just absolutely skyrocketing, and many orders of magnitude more than anything we've seen in the past, and that's obviously very striking. But if you do the same sorts of comparisons, like at a more local level, in the aftermath of natural disasters, then what we're looking at right now actually seems quite consistent with those types of experiences. And so, in our work, we were looking at Fort McMurray. We also, there are economists at the Federal Reserve, for example, that have done similar work showing that labor market outcomes in the U.S. recently have looked very similar to what was observed in the aftermath of Hurricane Katrina. So the similarities are definitely there, and I think, like, especially for thinking through the the sort of near-term impacts, that's probably sort of like a better framework to use. I think it's also worth noting that the economic policy response we've seen also much more closely resembles disaster relief than the sort of standard recession stimulus that we've seen in the past. But this kind of natural disaster analogy becomes a lot less useful when you think about the longer term impacts and the recovery phase of this crisis. And when it comes to disasters, they're typically short-lived. They occur over like a well-defined period of time. There's often physical destruction that has to be addressed, but it's clear what needs to be done, and you can start rebuilding right away. What's really difficult about this situation is just the high degree of uncertainty everyone's living with. The pandemic has already been with us for a number of months. There's a lot of uncertainty about potential future waves, when and if a vaccine will be developed, and so on. And so, that means the second phase of this is obviously going to be much more challenging.
Mm-hmm. That's super interesting. So in your note, you did an analysis comparing or analyzing sort of the Fort McMurray, you mentioned the wildfires, to understand how their economy sort of responded to that natural disaster. And I think one of the things that was interesting was you sort of looked at EI claims in Fort McMurray, sort of following the financial crisis in 2008 and the recession, versus the wildfires. And I'm going to pull that up because I thought it was a super interesting slide. You can see that here. So yeah, so in blue, basically, we see this really steep spike in EI claims, followed by this gradual decline versus, you know, the 2008 recession, where it's obviously a far slower increase. And I think this is kind of a good example of what your, kind of one of your points is, that it's not really helpful to compare to recessions. It's really sort of these shock natural disasters. And I think this really kind of captures, you know, obviously the effect on employment. And I also liked another thing that you kind of mentioned too earlier is sort of the similarities in the policy responses. So it was interesting reading in your note, like how many similarities there were between the government support for the wildfires and today. I mean, there were emergency income support, a lot like the CERB payments, mortgage deferrals of up to 4 months, accelerated EI claims. So there are a lot of these additional supports for people in Fort McMurray. So it's interesting to sort of see those similarities between the two. So now one of the lessons you wanted to try to learn from Fort McMurray was how mortgage arrears changed following the wildfires in Fort McMurray. And I believe you sort of compared what was going on in Fort McMurray to a control group to understand. So maybe if you can walk us through kind of how that worked.
Sure. Yes. I mean, you know, the basic idea there is, you know, we take Fort McMurray, you know, compare it to a control group that's, you know, made out of other areas within Alberta where the consumers have very similar characteristics to those residing in Fort McMurray, but that, you know, obviously didn't experience the wildfires, and therefore they serve as a control group. And so you can see very clearly in the aftermath of the wildfires, the mortgage arrears rate goes up quite significantly in Fort McMurray relative to that, you know, control group, but then also comes down quite quickly, and then, you know, I guess afterwards remains about, you know, 25 basis points or so above what you see in that control group.
Yeah, so that was interesting. So we have the control group in yellow. And obviously, we're seeing a very big spike in the Fort McMurray arrears just following the wildfires. So, and then of course, leveling off after. So that was super interesting. Now, one of the things you mentioned in your note, again, also that I thought was interesting was that, you know, while it's helpful to sort of do this comparison against these natural disasters, sort of to understand the immediate sort of effects, you kind of touched on how the recovery might be a little bit different, and it might be dependent on several different factors going forward. So what are the key things you think that are going to impact how we recover, you know, in comparison to, say, some of these natural disasters?
Sure. So I think, I mean, you know, one thing that's always very, you know, important when you're facing kind of like a large negative shock is, you know, initial conditions. So, and I think that's one thing worth highlighting in Fort McMurray as well, is that, you know, when the wildfires hit, you know, that's an area that had already been struggling for some time, you know, with the decline in oil prices that had occurred about a year or so prior. And so, you know, financial stress was already quite high, you know, even before that shock hit. And so for some people, that might have just been, you know, the final nail in the coffin. Now, at the national level, of course, what we've been concerned about for many years now is the high level of household debt. And, you know, so that's obviously the sort of number one kind of pre-existing condition that was there when the pandemic struck. And what we're particularly concerned with is, you know, to what extent those two things interact with each other. And, you know, there's been a lot of news, of course, about, you know, a lot of Canadians deferring mortgages, and, you know, what that could mean for, you know, eventual defaults. And, you know, so I think that's something we also tackle later on in our notes. So we, you know, provided a simulation of, you know, to what extent the mortgage arrears rate at the national level might rise, conditional on some assumptions about how the labor market might recover. And I think the fact that these deferrals have been available are really, really important, and you see that in our simulation too, because we sort of show what the results would look like with and without the option to defer payments. And what the deferrals essentially do is they buy time for incomes to come back before people are on the hook for making their payments again. And so at the end of the day, like ultimately what matters most when it comes to defaults is people having a job, having their incomes. But then what the deferrals are doing there is they're essentially buying time for that process to unfold.
So I'm going to pull up your simulation. So basically, from what you did was you kind of looked at what the arrears may have looked like following COVID with no deferrals, doing the simulation and looking at kind of how the mortgage deferrals that the big banks are putting in place may impact sort of deferrals in the future, or arrears in the future, I should add. And this is kind of what you came up with. And this is sort of the yellow chart or the yellow line effectively showing what the arrears would likely have looked like in Canada, mortgage arrears without any mortgage deferrals, and how the mortgage deferrals put in by the banks has really kind of eased that off, at least in the short term. I mean, it might result in a slight increase in the longer term, but we're not seeing this big spike, which is the key thing. Yeah. Now, one thing actually I wanted to mention, kind of going back to this idea, and I forgot to bring it up when we looked at your chart on Fort McMurray, that did have a big spike in mortgage arrears following the wildfires. What was behind that? Because it's a little bit different from this model. Right. Understanding why those spiked in Fort McMurray.
Yeah, so that's a really good question. I guess one sort of important caveat for the Fort McMurray chart is that we know mortgage payment deferrals were being offered to residents of Fort McMurray, but that's not something that we could observe explicitly in our data set. So one, it is just possible that some of that kind of initial increase in arrears is artificial. It could be that some of those people were granted deferrals, but they're sort of showing up in the data set as people that are behind on payments, which is why you don't have that more delayed sort of pattern that we have here in our simulation. The other thing I'd also mention is what I touched on briefly before is initial conditions. A lot of people may have just been on the brink already in Fort McMurray, given that most measures of financial stress were already quite elevated. Yeah. Even before the wildfires, whereas that hasn't really been the case at the national level prior to this pandemic. And so I think with those deferrals in play, in many cases for up to 6 months, what you would expect is this pattern where things are very flat sort of in the short run. And then you have a bit of this aspect of maybe kicking the can down the road for some people, because and I guess I should clarify that in this simulation, where assuming that the unemployment rate more or less returns to its pre-pandemic level within 4 quarters. Now that's not a prediction. This is just like an illustration. And I think we had a similar simulation we published in the Financial System Review that had kind of like a more pessimistic labor market scenario. And so the peak arrears rate there was a bit higher than the roughly 0.6 that we have in this picture. But the shape is very much the same, and that just reflects that once the deferrals are out of the system, you will have some people whose incomes haven't come back, and then they're the ones that are likely to fall behind on their payments. And when you look at something like 0.6, like it sounds very small, but it's actually quite large compared to the history of mortgage arrears in Canada. I think the highest rate we've ever had was around 1% back in the 1980s. I think the peak following the last recession was a bit under 0.5. So even numbers like 0.6 aren't trivial by any means.
That's actually a great which raises a great question. Now, a lot of people are hearing about I'm gonna have a sip of water. A lot of people are hearing about anywhere from 15+% of households right now deferring their mortgage payments. And I think CMHC had said that could go up to even as high as 20% by September.
Right.
So I guess for a lot of people, they're trying, maybe like help us unpack how we go from this idea that 20% of people are deferring their mortgages, possibly less than 1% may actually only be in arrears in the future. Is it, are more people deferring than need to? Like, what's kind of the disconnect? I think a lot of people are expecting it to be a lot higher.
Sure. So that's a great question. I mean, I guess there are a few things. One, as you just alluded to, there may be some people that are taking those deferrals, for precautionary reasons. They may not have actually lost their incomes. We have heard some of that anecdotally, but it's hard to know just how large that is. But I think more generally, what 15% is telling us is that a lot of people have been hit hard by the pandemic. A lot of people have lost incomes, not just from layoffs, but also by having their hours cut and so on. And so in some sense, that 15% is just telling us what we already know from the labor market data, which is that this is a very large shock. Now, how we go from something like 15% to less than 1% actually falling behind on payments later on, well, one, it again really hinges on how fast those incomes come back. And I think it's again, as I said, like it's not reasonable to think that everything will be back within a few months from now. But it is reasonable to expect that we will have some sort of recovery, and we've already seen that even in the May data. The employment ticked up a little bit. Most other indicators we're seeing suggest that the economy really sort of troughed in April. So there are question marks about how robust the recovery will be. But there will be some sort of recovery, and so like a lot of those people deferring mortgage payments, will hopefully be back on their feet by the time the deferrals are out of their system. The other thing I would point out, and this is reflected in our modeling too, but one thing that we see very clearly in the micro data we work with is people will generally exhaust all available options before falling behind on their mortgage payments. And so that could be anything from dipping into savings to drawing down credit lines. And that's not ideal, of course, especially given we had high debt levels to begin with going into this situation. But that is nevertheless a viable option for many households. So even once the deferrals are no longer available, there are some people that will be able to buy themselves time. So that also ends up being an important factor in these simulations, because we essentially start with kind of household balance sheets, and so we know what everyone's financial situation looks like, and then you kind of assume that once things like CERB and deferrals run out, if people don't have their jobs back, then they start drawing on whatever other buffers they have. And I guess like one other thing worth mentioning when it comes to mortgage defaults especially is that what we're really concerned about there is not just unemployment, but it's also the dual trigger of unemployment and a large decline in house prices. And so far at least we only have one of those ingredients. And that's not to say the housing market won't face important challenges going forward, and I'm sure this will be covered quite extensively over the course of this conference too. There are things like immigration, which were obviously playing a huge role in housing demand before the pandemic, that likely to soften going forward. But at the end of the day, most Canadians do have a healthy amount of equity in their homes, and it would take quite a sizable decline in house prices to really move the needle on that.
Yeah, that's actually a great point. I mean, that's kind of one thing that I've been sort of obviously keeping in mind in this, is that over the years, I mean, certainly Canadians, or at least especially in cities like Toronto, do have a healthy amount of equity. And I mean, you raise a good point that it is sort of this combination of unemployment and a decline in house prices. That's kind of the two things together that make things quite bad. And so far we've been able to weather, at least in the short term, some of the unemployment obviously hits. Now, one of the things that you did, which I thought was really interesting in the context of trying to understand how high levels of household debt might impact our ability to kind of get through this, is again, I think you did a simulation where you tried to understand, how many households could weather this income shock and for how long. And I think you had some interesting findings in sort of the number of households that could get by, at least even in the short term.
Right. So what we were looking at there, and I guess the sort of features and what I was describing about people having their own resources potentially to draw on once the deferrals are no longer available. But we're essentially looking at what kind of financial buffers people have in place, and so this was based on some definition of liquid assets, which I believe was cash and financial assets that can be sort of easily liquidated. And then to kind of put those into a simple summary measure, we were seeing, how many months of mortgage payments could people make just by drawing on their financial assets. And, so you see over there that, I think the basic story is that a lot of people don't have, many buffers in place. I think about, 20% of Canadians have, less than 2 months of mortgage payments. When you look at that metric.
Liquid to cover their mortgage payment in the short term. Okay.
Exactly, but there's there's a huge range when you look at it across occupations. Some people have many months or even years worth, and whereas others have had very little. And I guess what is a bit of a concern right now is when you look at households working in the types of occupations that have been disproportionately affected by the pandemic. They are the ones that also have sort of the most limited financial buffers.
Yeah, that's actually a very good point. I mean, we're kind of seeing that on the ground right now. Unfortunately, is kind of one of the side effects of this pandemic. Now, before we kind of jump on to one more question, in Governor Macklin's first speech, he said that as the economy reopens, people go back to work. We should see some positive signs, but the pandemic is likely to cause some long-lasting damage and the recovery will be bumpy. Now, what are some of the key things that the Bank of Canada is looking at in terms of metrics to kind of try to understand or make sense of how well our recovery is going in the future?
Right. So that's a good question. I mean, I guess, like at least personally, when it comes to when it comes to bumpiness in the recovery, there's sort of two things that I'll kind of be looking at closely, and like the first really gets at this question that I think has kind of been in the background of most of our discussions, which is to what extent will we see defaults or insolvencies maybe rise to the extent that they could actually derail the recovery. I think it's reasonable to expect some sort of increase. What we'd be concerned about there is a very large scale increase. And I think insolvency filings in particular, I'll be watching very closely for a couple of reasons. I think if you look at the history of insolvency filings in Canada, it's predominantly been a story of renters with unmanageable consumer debt that end up filing for insolvency. And that's not to say homeowners don't get into trouble, but certainly like the vast majority of insolvency filings tend to come from renters. And at the same time, we know that the pandemic is disproportionately hitting sort of lower income households that are more likely to be renters and homeowners. And so in that sense, I think, insolvency filings is one space where we're likely to see probably more movement than with mortgages, which is what we've mostly been discussing today. And then, of course, insolvency filings, not just on the consumer side, but, on the business side too, to get a sense of, to what extent the sort of productive capacity of the economy could be hindered going forward if you have sort of very high amount of firm closures and maybe not too much new firm creation, given the high degree of uncertainty that's sort of persisting right now. And then I think the second question that'll be really important to get a handle on is to what extent are we seeing maybe sort of more fundamental shifts in behavior that could restrain the recovery? And so on the household side, I'm thinking, will we see, people increase their precautionary savings or, prioritize paying down debts instead of actually spending? And that's the type of question that's very difficult to answer. That there's no sort of simple indicator you can track to really know how that's playing out. But I think that's one area where it'll be really important to sort of work with microdata to really get a sense of how different households have been affected by the pandemic and how their behavior might be shifting.
So when you talk about the behavioral shifts of people potentially saving money, paying down debt, I mean, is the idea with that if we're saving our money, we're paying our debt, it's not going to the businesses, right? It's not kind of flowing through the economy. We're effectively deleveraging in some ways. Is that
exactly.
Is that kind of the
yes, exactly. That's exactly it. So that's something which would like directly weigh on household spending, for example, during the recovery phase.
Yeah, that's super interesting because I mean we've heard obviously during this slowdown a lot of people saving money because I mean quite frankly they can't go out, they can't do anything. So and savings have gone up. So certainly I mean and it's interesting I think for a lot of people to think about savings as potentially in some ways like a negative thing, because generally we think about savings as something that's positive. We should save our money, we shouldn't spend it. But certainly when we're looking at sort of the economic effect, 100% that, the more we're saving, we're not spending and spending and effectively giving to businesses is going to impact our recovery in some way. So that's certainly an interesting thing to be mindful of how it might impact the recovery going forward.
Yeah, and I mean, I'd say, one thing that's very interesting right now, and some of my colleagues have a note coming out on this in a few weeks that I think is really informative, is just the sort of high degree of sort of heterogeneity right now within the household sector, because like as you said, like a lot of people have increased their savings quite a bit just because there isn't much to spend on, and these are obviously people that haven't lost their incomes and tend to be generally better off. And we've seen that in the data already. Even in Q1, the savings rate rose quite a bit. When you look at like monthly data just on deposits in personal bank accounts, I mean they've surged. So clearly there is sort of these excess savings that are going to be sitting there, and one big question is how and if those will be spent going forward, and that'd be really important for for how household spending plays out over the next couple of years. But then at the same time, you have people that have been hit very hard. They've lost their incomes, and for now, they're being kept afloat by CERB and the ability to defer payments and so on. But some of those will face sort of more persistent financial challenges, and some of them, as I said earlier, might end up in extreme cases filing for insolvency. But even those that don't, may actually rely on even more debt accumulation to get by, for the period where they still don't have their incomes fully restored. And so again, that's something which will weigh on household spending. And so how all of these very different experiences net out in the end is going to be really important.
Yeah. Now on this topic, I mean, on insolvencies, you kind of mentioned and that they have disproportionately been renters in the past. Now going forward, should we be more concerned about increase in homeowners being insolvent? I mean, and the impact that might have on the housing market. I mean, just obviously insolvencies in general are bad, but in terms of sort of this macro impact on the economy, is it, should we be more concerned about sort of people defaulting on their mortgages and those, insolvencies as increasing?
Yeah, I mean, I think again that's something that really comes down to house prices. Like as long as there isn't a major decline in house prices, I don't think for the majority of homeowners that that would end up making a whole lot of sense. I think that the main advantage there when you look at kind of the legislation around insolvencies is that if you're in a situation where you're underwater on your home and you file for insolvency, then that, shortfall, which is really a secured shortfall, actually gets converted into an unsecured shortfall and kind of pooled together with all of your other debts that'll then either be discharged or, renegotiated depending on what kind of insolvency filing you're going for. But, I think even in, cases where if you have a homeowner that simply can't make their mortgage payments anymore, as long as they have equity in their homes and, the housing market is relatively stable, there's always just simply the option to sell without kind of resorting to those sorts of measures.
Yeah, that's actually a great point. I think it's something that I think has been missing in the discussion and thinking around the insolvencies. I mean, when people think about homeowners going insolvent, and it goes to your point. At the end of the day, I mean, if you have equity in your home, you're not going to fire sale your house. And I think, I guess, from what I'm hearing is like in the future, people might have, or homeowners are probably likely might have issues with liquidity, meaning they just have no cash coming in and pay their mortgage, but probably aren't insolvent because they have equity in their home. So their worst cases, they sell their home and they move on, which I think is a very different, obviously, scenario. And of course, I mean, to your point, I mean, if we end up in this environment where house prices starts to cool, I mean, that kind of obviously changes the dynamics a fair bit, but I do think that's an interesting point.
Yeah, and I guess, one thing I would just say is if you had, those sorts of, sales happening on a large enough scale, then, that itself would put downward pressure on house prices.
Yeah.
But that's, of course, not sort of what we're expecting as a base case outcome.
Yeah, you're right. I mean, if a lot of homeowners are stretched financially and they need to, sell their homes quickly, I mean, certainly in some markets, it's going to have a big impact potentially on home prices, but we'll cross that bridge when we get there. All right, we're nearing the end, and I'm just going to wrap up with two last questions that we're asking all of our guests. So the theme of our summit this year is smart caution, and I'm just curious to know what smart caution would mean to you.
Yeah, well, that's a good question. I mean, like, I think, the experience of, like the last few months, I think definitely have the potential to sort of, as I said, change behavior in many different ways going forward. And, I think we've all sort of seen just how rapidly things can change, almost, overnight. And I think one of the takeaways from there is, maybe, just to sort of, make sure that you do kind of have, those buffers in place and, kind of have like emergency plans to sort of, deal with these types of situations.
Yeah, smart advice. And then our last one, of course, would you buy or sell a home right now?
That's actually a really funny question because, like right before the pandemic, we were actually considering, selling our home, and moving closer to the city. And, like the main motivation there was just that the commute was becoming unbearable. And, now with everyone working from home, we have all the perks of living in the suburbs and none of those commuting costs. And so it's really like not top of mind anymore. And so, just for that reason, we're not going to be active in the housing market. But, personally, I tend to be very like risk averse. I probably wouldn't list my home in the middle of a pandemic. But, there are 3 homes listed on my street right now. So, clearly activity has already picked up quite substantially.
Yeah, it's interesting how this has really changed, even these behaviors of where people are fine living and in your case, all of a sudden the commute's not an issue. And, that might be the case for a while still, we'll see. But for sure, I think we're going to start seeing a lot more people working from home in the years ahead. So thank you so much for taking time today to speak with us. I got a lot out of it. Hopefully our viewers got a lot out of it, and really appreciate your feedback and time today. So thank you so much.
Right. Thanks, Sean.